This recording is an awesome activity that I have done for years with my personal finance students and my entrepreneur students in the high school. My name is Denise Lee, and I've been teaching business education for over 20 years. And I love lessons that incorporate aha moments for my students. This one definitely does. So let's get started. Students are often very confused about buying a home and what it entails. And quite frankly, you don't have to go into the details of buying a home with young people before they graduate from high school, but to see the big picture and for them to understand applying for a loan and amortization, that is the key. So I use this blank worksheet in Excel, and I bring up um, amortization in my search. And I love this second one that says loan amortization schedule. Now, this is a template that's built into Excel. Click Create. And I have found this to be just a truly awesome tool for my students. So here is the example that they give you on Excel, and the median household income, value in our school district is a home that is $150,000. So I use that as an example for the loan amount. So I tell my students, let's imagine that you are buying a home for $150,000. I also explain to them about credit and how if you have really good credit, every major purchase that you make that you have to borrow money to purchase that item will be on sale for the rest of your life, or at least as long as you maintain that good credit score. So I'm going to go ahead and keep the 4% in here, but I usually look at the Fed funds rates and I look at what mortgages are currently, and I change it according to what I see online. But the loan period in years, obviously not 1 year, but I tell them that usually we purchase a home and we pay it off in 30 years. Number of payments per year, I let them keep that at 12 months per year. And then the start date, I just tell them to go ahead and use today's date for the start date. As far as optional extra payments, I tell them to put 0 in there. Now, we do play around with these numbers throughout the activity, but for now, I'm going to tell them to just make no extra payments yearly. It's really important that you walk through each of these steps with your students so they understand they're buying a $150,000 home at 4% for 30 years, and they're making 12 payments, monthly payments a year. So Excel does all of this magic for you. And this is what I love. As I was changing these numbers, you may have noticed that these numbers were changing. The scheduled payment monthly would be $716.12. The scheduled number of payments is 360 payments throughout the 30 years. And then the total early payments, we put 0 in here. And then the total interest that they will pay in 30 years for a $150,000 home is $107,804.26. This is the part that they just can't believe, that if they didn't make any extra payments throughout the 30 years, that they would essentially be paying back almost $8,000 in mortgage interest. So again, my students are shocked at this reality, and they often will even ask me, is this legal? And I quickly respond, it is legal. It's not only legal, but it is the industry standard. So let's take a look at this schedule here. And if you've ever purchased a home, you know that you get this amortization schedule. It's often 20 pages long. Because of the Truth in Lending Act, mortgage companies have to give you a amortization schedule so that you can see in black and white what you'll be paying off throughout the years. So the first payment I tell my students that they're making on this $150,000 home is obviously the $716. That never changes throughout the life of the loan. No extra payments, total payment, This is how much of this $715,000 is principal, and this is how much of it is interest. Now I tell them as I scan down through this schedule, I want them to look at the interest. So I tell them this payment never changes, but as I'm scrolling down, you can see that throughout the life of the loan, the amount of interest that they pay throughout the years goes down. This payment has stayed the same. Here I am in the year of 2039, and it is down to, in 2043, 141 of that 716 is interest. So I let them see that as you pay the life of the loan, the amount of principal of this money increases and the amount of interest of this payment decreases. Again, this is a great activity for kids to realize what a loan schedule looks like, what the word amortization means, and how much really throughout the life of this loan we pay in interest. Now, I do a variety of things with my students with this amortization schedule that's built into Excel. One thing that I do is I tell them, now let's tweak the numbers. Let's make an extra $200 payment a year, just $200 a year. And we see that that $107,000 that we paid in interest throughout the year now changed. That is just by making a $200 extra payment a year. And look at how that has changed. So I tell them this number, just $200, which could be just a couple nights out at a restaurant a year, really makes a big difference when you look at the 30-year amortization schedule. So I tell them, sometimes we see advertisements, pay your home off early, and this is the way to do it, is to put extra money on it. I also do this activity with them. I say, okay, let's say you really have bad credit, and a mortgage company, a bank, will lend you money, but sometimes they'll lend you money at a bad interest rate. But you need a place to live. So, of course, you get the loan because you need a place to live. So, if you have a bad credit score, it is not at all unusual for you to pay 8% for a mortgage. So if you're paying 8% for a mortgage on a $150,000 home, and I'm going to change this to, again, 0 extra payments a year, then you are paying back of this $150,000 loan $246,232.87 throughout the life of the loan. And look at what happened to our payment. We went from a $700 payment to an $1,100 payment monthly, which is an enormous difference in your monthly payment to your bank. The other thing that you cannot forget is this. I make sure the kids know, okay, so in our first example, it was a $700 payment monthly. I get that, but you probably are going to have hundreds of dollars in taxes, and then of course homeowners insurance on top of that. And that doesn't change regardless of how long you have your mortgage, but it does change with the value of your home. Of course, your taxes go up as the value of your home increases, and your insurance goes up. And I explain to them why that is. There are so many things you can do with this amortization schedule as far as activities. I have my students go on realtor.com. I have them choose a home in our school district that's currently on sale, it's currently for sale. And I don't give them a budget. I want them to really pick a home that they would live in. And I have them do 3 examples of an amortization schedule. I give them the example. I tell them to put the amount in here, and then I have a good credit example with a good interest rate, and I have a bad credit example with a bad interest rate. After they do that example, I have them write a reality statement, I call it. In their reality statement, I want them to tell me the benefits of having a good credit score, and then I have them give me a reality statement of the downfalls of having a score that isn't so great and the reality of the numbers. And then I have them in the third example do this extra payment thing. I say, let's say we throw an extra $50, even a month, in extra on our mortgage. That entire $50 goes to the principal. So I have them calculate how much extra payments annually would it be if we made a $50 payment, of course, per month. That would be $600 a year. And if they put $600 in here, I tell them, watch this number over here as I click enter change dramatically with just $50 more a month. So there's so much that you can do with this activity. And like I said, it's a great aha moment for our young people to understand really how much we pay back in interest throughout a 30-year mortgage. I do have them do an example where we change this to a 20-year mortgage and a 15-year mortgage. But we talk about that, like, would it be beneficial to get a 30 or a 15-year mortgage? What if there's a time in your life where you can't make that mortgage payment? So would it be better to get the 30-year mortgage and make extra payments and really discipline yourself to do that? So if there were times when you were cash strapped, you could just make the minimum payment. So we discussed this, and this is all part of growing up and big reality checks in being an adult and personal finance. Again, my name is Denise Lee. I have a TPT store, Business Ed with Denise Lee. And in the comments below, I'm going to add a link to a resource that can be purchased on my store that accompanies a loan amortization schedule and home buying activity for your students. Thank you for listening.